everyone, welcome back to my channel where I share insights on Bursa Malaysia stocks and the latest economic news. On the 2nd January this year, Bank Negara Malaysia announced that it may lower the overnight policy rate, or in short OPR, by 25 basis points to 2.75% in year 2025. This announcement sparked a lot of questions from my followers asking, will this be good or bad for Malaysian bank stocks? In today's video, we are diving into this topic where I will explain how this potential rate cut could impact Malaysian banks, which banks are likely to benefit and which may face challenges, and also my top 2 stock pick in this environment. If this sounds interesting, watch till the end and don't forget to like this video and subscribe to my channel so you never miss out on my future updates. Before we get into the impact on bank stocks, let's quickly go over what the OPR or overnight policy rate is and why it matters to us as Malaysians. The OPR is the interest rate set by Bank Negara Malaysia, which influences how much banks charge each other for overnight borrowing. But here is how it affects you and me. First, loan rates. If the OPR goes down, your home loan, car loan interest rate might drop, meaning lower monthly installment. If it goes up, borrowing becomes more expensive. Second, savings returns. A lower OPR often means banks will pay less interest on your savings or fixed deposit, which is a downside for savers. And third, the economy. A lower OPR can stimulate the economy by encouraging borrowing and spending. On the other hand, a higher OPR is used to cool down inflation and slow down excessive spending. In short, the OPR is a tool to balance economic growth and inflation. Why bank stock reacts to rate cuts? Now let's talk about how banks are affected when Bank Negara lowers the OPR. There are two sides to the coin, some positives and some challenges. First, let us talk about why bank stock can benefit from rate cuts. Higher loan demand. Lower interest rate makes borrowing cheaper, which encourages more people and businesses to take up loan, and bank benefits from increased loan volumes. Second, economic growth. As the economy improves, businesses grow, consumers spend more, and banks earn more from lending and fees. Third, liquidity boost. Rate cuts can drive more activities in the stock market as people move money from fixed deposit to equities. This in turn may push up bank stock prices. Valuation gains. Lower interest rates reduce the discount rate in valuation models, making bank stocks appear more attractive to investors. Now, let's talk about the potential challenges for banks. NIM or net interest margin compression. Banks earn money from the difference between what they charge on borrowers and what they pay on depositors. A rate cut narrows this gap, thus reducing profitability. Second, depositor behavior. Savers may move their money out of banks into higher yield investments, thus reducing low-cost funding for banks. Third, short-term profit squeeze. While loan demand may rise, but it takes time for banks to fully realize the benefits, so short-term earnings could be pressured. Next, winners and struggles. So, which bank could thrive in this environment and which might struggle? First, potential winners. Maybank and CIMB Bank. This bank have diversified operations including investment banking and regional exposure, which help them to offset the impact of narrower margins. Banks with high loan growth potential. Banks like Maybank, CIMB and Hong Leong banks are positioned to grow their loan books significantly, thus helping to mitigate margin compression. Now we come to the potential struggles. Public bank. While public bank is a highly efficient and conservative bank, public bank reliance on retail lending and its narrow margin could make it more vulnerable to rate cuts. Another example is Affin Bank. With weaker non-interest income streams, Affin Bank may face more pressures from both margin compressions and slower revenue growth. When evaluating the dividend performance of Malaysia's leading banks such as Maybank, Public Bank and CIMB, there are two key metrics for us to consider, which is the dividend yield and the dividend payout ratio. First, what is dividend yield? Dividend yield is a metric which is used to indicate the annual dividend income as a percentage of the current share prices, reflecting the return on the investment from dividends alone. As of year 2024, Maybank offers a dividend yield of approximately 5.94%, whereas Public Bank reported a dividend yield of 4.5% per annum and CIMB's dividend yield stands at around 4.71% per annum. And dividend payout ratios, which represents the proportions of net earnings distributed to shareholders as dividends, indicate how much profit is returned versus retained for future growth. Maybank recorded a dividend payout ratio of 73%, meaning out of 1 ringgit of its net income, Maybank distributed out 73 cents back to its shareholders in the form of dividend. Public Bank has a dividend payout ratio of 56% and CIMB recorded a payout ratio of 98%, which also means CIMB retained only 2% of its net income for future growth, which may not be so healthy from the point of its future growth prospect. Historical context. What happens after rate cuts? Looking at the history, Malaysian bank stock often experience a short-term dip when rates are cut because of concern about the net income margin. But over the medium to long term, as loan growth picks up and the economy improves, bank stocks typically recover and perform well. So these are my key takeaways. How to invest. How should we as investors position ourselves? Here are my tips. First, focus on banks with diverse income streams like Maybank and CIMB that can cushion the impact of rate cuts. Second, look out for strong loan growth potential, which is banks that are efficient in growing their loan books will benefit more in the long run. And third, pay attention to the macroeconomic indicators like GDP growth and consumer sentiments to gauge the broader recovery. That wraps up today's analysis. What do you think? Will Bank Negara's rate cut help or hurt Malaysian banks in the long term? Let me know in the comments below. And if you found value in this video, do smash onto the like button to show your support and subscribe to my channel for more insights on investing in the Malaysian stock market. Thanks for watching and I will see you again in the next video. Bye!